Hello, how are you doing? Welcome along to FTUK's weekly catch-up live stream. Hope all is well with you wherever you are in the world and whatever you have been trading. It's Friday the 25th of July, and this week in the catch-up, we've got quite a bit to get through. As always, there's always a lot to talk about. Discord is there. As always, please scan the QR code if you want to get involved in the community. Best place to find everything out about FTUK, be the first in the loop. And of course, please do subscribe to our YouTube channel, which is gaining popularity all the time, and some of the content now on that community post section is super cool. Really good stuff. Right, this week I'm going to jump straight in because there's some big meaty topics that we're going to need to get through. Weekly payouts, we will talk about that first, and then I'm going to talk about fixing a really bad habit that a lot of traders develop in their early stages of their careers, and once you're trapped in this loop, you can't get out of it, and that is when you end up moving your stop loss all the time, or even worse, actually removing your stop loss altogether, and how you can conquer that. It's a very simple fix. Bit of training, bit of discipline and exercise needs to be instigated, but you can fix it. And finally, I want to talk about the futures market. Futures is rapidly coming towards us now at FTUK, and in the next few weeks, and I thought we'd do a nice simple market primer. Nothing too complicated. We're not going to cover everything, but just some of the basics to get everybody in the loop if you've never been introduced to futures trading before. It sounds such a strange term, futures trading. What on earth does that mean? Okay, we'll talk about it and go through some of the basics. Right, let's jump in and let's look at the payouts for this week. Good across the board. Really strong. Fabia N, $1,701. Congratulations to you. We've also got Darlan N, $300. Fantastic. Well done to you, Darlan. Don't know how you've managed to do that, but it doesn't matter whether the amount is a large amount or a small amount, because a good payout is a good payout. So congratulations to you. Fred A as well, $4,060. That is very good indeed. And Joel P, $4,055. Congratulations to all of those people getting their payouts throughout the course of this week. It's good to see that steady stream of success happening within the middle of the market, like within the middle of the company like that. It's really good to see. Also as well, Ludmilla as well, congratulations to you, $828. Now the reason why I am talking about her last is because I was lucky enough to interview her earlier in the week, so she's going to feature as our trader interview for next week. This is going to be on the YouTube channel probably from Monday, something like that. Wow, what a trader, you know. And this is what I said this last week when we did the payouts. It's not actually about the amount that you're getting paid out. Okay, some of those guys made more money, and some people made less, but it's really about the quality of trade and your execution. That's really the hallmark of a good trader. I spoke to Ludmilla earlier this week. She's essentially a professional. She's been in the industry for 20 years, and she is only focused on trading the NASDAQ intraday over the last few months. Really good trader. I've got a little excerpt of the interview now. I'll play it for you, but she's going to be on the YouTube channel next week.
As a trader, it's always challenging. You see mistakes maybe that your company does while you are not in a decision maker position, or your decision has to be shared by many committee members, and you see, oh, they do it that way and I know better. If I would be a trader, I would do profits, and then you start your trader journey. And of course, I think many first traders with their first trades, they just make losses because you don't calculate your leverage, you don't basically you count only with profits and don't count with risks. After a while I also did CFA. I'm now a CFA charter holder, which also a lot of theory on risk helped a lot. And of course, as a trader, I must say now, to be successful, first understand risk and then go for profits.
Very interesting. She was just on her way to work. She works at a big investment firm, family office in Switzerland. And I think the two things that I got from her interview, which really resonated with me, was she's obviously been doing it a long time. She's got a CFA, so she's right at the pointy end and all the best qualifications and everything. But the two things that I got from her was a very deep understanding of risk, and then also a very deep understanding of leverage. And when we have a lot of gold traders, and she's focused on the NASDAQ, it's a very difficult market to work with intraday, and yet her trading is flawless. So the way that she's managing the risks, so you can feel that she's dealt with the leverage and the market volatility in the current environment just beautifully. It's a really good interview. Definitely something that you want to have a listen. We didn't find out too much about her strategy. As always, people want to keep the strategies to themselves. I totally get it. But just having that understanding that, by doing a CFA, which is one of the hardest qualifications you can do in finance, and then developing that understanding of risk and leverage, you can turn yourself into a very good trader indeed. Yeah, worth watching. Right, let's start talking about this. Have you ever been in a position where you have moved your stop loss? Have you ever been in a position where the market's come down to your position, your stop, you've been stopped out, and it's happened again and again and again, and then you end up starting to sort of like think, okay, well, I'll just give the market a bit more room, and you manually then start intervening. Have you ever done that? So many people have, and you end up starting to develop the most horrendous bad habit where you end up removing your stop loss altogether, and you're constantly adjusting it, and it really becomes detached from your strategy. So you'll often hear this kind of dialogue or this kind of stuff when you ask people the reasoning behind it. They say, well, I'll just give the trade a little bit more room. There's a strong compulsion after particularly a string of losses to then not want to see yourself stopped out. I get it, because you're losing money, particularly then when you then you then see the market constantly ping back, and you wouldn't have needed to take the loss at the end of the day, or maybe the market then carried on and then hit your profit target, but you're no longer on board on the trade. And then what people will do after that string of losses is they'll end up in a position where they'll start removing these stop losses altogether. I get it. It's a very, very complicated, emotional position to be in, and it's confusing, and it's not easy to work with, and it's very difficult to understand what is going on. So do you imagine this internal dialogue? You probably say this to yourself as you're moving or removing your stop loss, and you'll say things like, so why are you moving it? And you'll say things like, you'll convince yourself, you'll say things like, because I keep getting stopped out, only to see the market then come back in my direction, and I needn't have taken the loss at all, and therefore I would have been absolutely fine. Or alternatively, that internal dialogue might potentially say, yeah, but what happens if the market doesn't come back? So when you start removing that stop loss, you think, okay, well, actually, no, I have now got, if I don't have a stop loss altogether, then I have no form of risk management. So what you do, particularly in Forex and CFD markets, you then start saying, okay, well, I'll start hedging in the other direction, because of course you can do that with currency pairs and on these types of trading platforms. You can buy and sell at the same time and have equalized positions or different size positions on the same instrument, and that ends up being a very, very common way that people start to deal with it. So they'll say, well, I'll start hedging. If I hedge in the other direction, I'm a smart trader, I'm not going to lose any money anymore. Why? Because I'm not losing the money, I'm protecting the position, and I can also liquidate the hedge for extra profit. So they start to convince themselves that this is going to be a really good idea, but it's a problem. It's a massive problem, and the problem is really goes back to the fact that they can't take the loss. They can't accept the initial loss of being wrong. And that maybe comes from bad education of not knowing where to place a stop in the first place. If they'd understood how to do that a little bit better, they wouldn't have ended up in this situation from the beginning. So it can be a very, very difficult thing to deal with. They can't accept the loss, and they don't believe that good trades will offset any of the losses. And so they end up in what I would describe as being a loop. And this is what it essentially looks like. So if you imagine that you've got all of your trades moving in this direction here, they end up in a cycle that they can't get out of. They see the market going against them, and they don't have a stop loss because they've decided they're sick of losing money, so they're going to work without it. Why? Because the market always comes back, and it's not coming back this time, so they decide, do you know what? I'm not going to take the loss. I'll hedge in the other direction. And they get locked into this hedged position. It's very, very, very common, and that feels like you're protecting yourself, but you're not. Really, what you are is stuck. You're stuck because you can't accept taking the loss. And then what happens is you then start to miss other opportunities that come along because you're carrying this hedge mentally in your mind. It's very, very difficult. So what you don't see is you don't see what happens when you take losses, and then get an outsized gain, because it's very difficult. It's very difficult to put yourself in a position where you are going to be able to experience what a really outsized positive trade is going to give you when you're locked in this cycle. The hedge itself makes the trading on the account much harder as well. Why? Because you end up with your trades being twice expensive. You're paying the swap twice, you're paying rollover fees, and you're paying the spread twice as well. It also then weakens your account too as well, because you're operating from a point of view of drawdown. Yeah, so you're adding in more leverage on an account that is in a weakened condition. You can't necessarily from that point see the market as clearly. Why? Because you're carrying around this outsized position. And I've seen people that will trade like this, and they'll hold losing trades that are hedged. They'll hold them for months. I mean, literally months, because they can't get out. They can't get out of it. And all of a sudden they lose that mental clarity. They don't have the mental, that lightness of flexibility anymore, because they're carrying around this mistake that they're trying to protect and they're trying to work their way out of. And they never get to experience this. They never get to experience the lightness of being wrong, and then being right, and then using that profit to then offset all of those occasions of being wrong. It's a mess. It's a real mess. And it all comes back to not being able to accept taking a loss in the first place. Now, what is the solution? Well, the solution really is that you need to be okay with taking losses. But I get it, that's hard to do when you're starting and you keep being wrong and you're watching your account dwindle away. But there is a very simple solution, and this is basically it. It's a simple set of exercises. Now, when I'm big on training, I think that training in markets is just as important as it is in any area of life. It's not just a platform for you to generate profits from. I mean, ultimately that's the goal, but as you're learning any skill, you need training tools to do that. There's nothing wrong with using the functions in the market and the tools you have at your disposal just purely from a point of view of training yourself. And this is a good use of that. So we've got a training exercise, and this is for demo accounts only. This is, do not do this with your paid accounts. Yeah, this is not about making money. This is about reprogramming your mind. So it's demo accounts only. Yeah, whether that's on TradingView or any platform, download a 14-day trial of our trading platforms, and you can still do the same thing. And what we're going to do is we're going to need to find points in the market where we're expecting volatility. So this is a news news event training strategy to help you be okay with taking a loss. And I'm going to show you how it works in a second. It's very fast. We want very fast feedback. So I'm not an advocate of trading on 1-minute charts. I think it's a very immensely difficult way to try and be effective as a trader. But in terms of feedback for training, it's cool because you get very, very, very fast results back from this, and you can learn very quickly. So this is a training exercise where it's demo accounts only. Do not do this with real money. Do not do this on real prop accounts or anything like that. This is just purely for training purposes. You need to trade volatile markets as well. So news events, non-farm payrolls, CPIs, any big events in the market where we're expecting volatility, that is going to be the points in the market to try and work like this. And then also as well, very fast time frames as well. So the 1 minute, 5 minutes, something like that. Now, what is it and how does it work? Well, this is what we're basically going to do. You'll see me say in my analysis, and you'll see me say in live streams as well, you'll see me say, like, you know, a line in the sand. I'm a big fan of lines in the sand because they demarcate a very clear set of rules. And this is what we are essentially going to do. We're going to look for a volatile news event, and what we're going to do is we're going to trade long above it, and we're going to trade short below it. Yeah. So as the market starts, say for example, you've got a non-farm payroll coming up here, we are expecting an expansion in volatility. I would say that was not always, but 95% of the time, you're gonna get an expansion of volatility. That is something that we can capitalize on. We can use that to our advantage when we are training like this. And what we're looking for is we're looking for a market that is, say for example, a news event is gonna occur. What we're gonna do is we are gonna buy above that line and we are gonna sell below it. So we're gonna go long at market. You don't need to use a stop loss. This is just a reflex training exercise. We're going to buy above it and we're going to sell below it. And then as the market then starts to cross the line, you're going to liquidate the losing side. So if you imagine that you've got this point here, you're going to buy in here. And then, of course, the market starts to move in your favor, but it goes against you and it goes on the opposite side. As soon as it goes over the line, as soon as it crosses that line in the sand, what we are going to do is you're going to get out. No matter what, it doesn't matter. This is just an exercise. And what you're doing is you're slowly starting to allow your brain to accept the loss. That's what you're doing. So as soon as it crosses that set, you get out. It's okay. And then what you then do, as soon as you've gotten out, is you jump straight back in again at market on the opposite side. So at this point here, you would now become a short seller and you would then sell the market. Again, you can see that doesn't happen and you get chopped up left, right, and center. Yeah, you get chopped up on both sides of the market. You keep going with that process. Yeah. And then what happens as the volatility expands, we get bigger ranges. So what we're looking to do is to end up on the correct side of the market because we don't know which way it's going to go. And then we're looking to pyramid in. And that pyramiding in process on the correct side of the market eventually should give you, not every single time, because it won't work every single time, but it should start to give you a sequence of trading events where the overall profits that you're going to get are going to offset this bit here where you got chopped up. That's what we're looking for. So let me just draw that out for you so that you can see it on a chart. Well, in fact, before we do that, this is what it essentially would look like. So you can see it here. So you can see maybe I would go short in there like that, and then I would have to come out of the market, and then the market goes below the line again. Yeah. And then I have to short again and I get chopped up. So that's two trades that I'm now taking losses on. But also notice as well that they relatively contain small losses. As the market then carries on, I then go on the opposite side and I start to buy the market and I pyramid in. So every subsequent high, I then start to layer in. Now, if the market then careers back down, I keep repeating the process. And eventually what you'll start to see, if you practice this, and this is why this is not a money-making exercise, this is because it is risky. But what you'll start to see is you'll start to see occasions when you layer in like that and you're on the right side of that expansion in volatility. And then when you liquidate a bit further up the road, because you've got that, the market has moved to a different price range, and you get out, you'll start to see that all of those profits that you now created offset those small losses. That's it. That's what you're looking for. That's the gateway into fixing the mental framework in your mind, saying that I can't take the stop loss. I have to move my stop loss. I can't be okay with being stopped out of the market. That's the sequence that you need to see. Let's put that onto the just to draw it out on an example here. There you go. Oh, I'm sorry. It's that one there. Too many buttons to press. You can see it here. So got that market. That's the line in the sand. That's where we're going to go. So we'll use non-farm payrolls because non-farm payrolls is happening next Friday. So this will be a good reason to pay attention to this. Open a demo account with a brokerage or download a free trial and give this a try just for free trials. This is not a money-making exercise. So you get the non-farm payroll is going to occur there at the 30-minute, at the half-hour mark, yeah? So the market comes in. At this point here, obviously the spread is going to widen, but only relatively temporarily. But we are expecting the market to expand its range, yeah? So that's exactly what we do. So we go here, the market goes down, and we become a short seller. We start selling like that, and the market keeps going. Great. As it makes a new low there, we add in again. Now the market comes back, and it's here. Okay, right, get out. Get rid of both of those short positions, and then turn around and go long and start buying. And then you get that kind of thing. Okay, we're chopped up again. And you can see we're accruing a small pot of losses there. But the thing is, they're all relatively contained because we're only operating initially around that central pivot point of the of this line in the sand. So we're looking to place that line as close to where the news event starts as possible. That's going to be our reference point, yeah? And then eventually you'll get that. It doesn't really matter which side of the market we're on. We're flexible. We're not bothered whether we're going to be on the long side. We're not bothered whether we're going to be on the short side. What we're bothered about is pyramiding into the volatility as the range is expanding. That is the important bit. So say, for example, in this instance here, we then go short yet again here like that. And then as we then make a new low, we get short again. And then maybe a third time, something like that. And then we liquidate. And then what you'll see is that all of these short trades here, what they do is the profits that we generated by pyramiding in that expansion of volatility, they will offset, if not give you a small profit, based on this. And what that's doing is it's allowing your mind to be okay with executing when you're wrong, which means that you are okay taking your losses. You're okay with being stopped out of the market. And what that will do is it will allow you to it will allow you to break out of the cycle of this loop here. There. It will allow you to get out of there. So you stand a chance of starting to experience this. Experiencing this positive effect here is the gateway to being okay with this. And I know this because I've done it myself and it works. But it's a training exercise only. I can't emphasize that enough. So this is basically it, yeah? In word form, yeah? So we're looking for an expansion volatility. You buy above the line in the sand, close to the news event, or you sell below it. The line in the sand tells you when you're wrong, and then you get out and you reverse your direction, yeah? You repeat that process as the volatility expands and the market is finding its range in that expansion of volatility. You add in on the winning side as the market starts to go, which is why you want to do it on fast time frames as well, because you just want very fast feedback because the markets don't necessarily stay that volatile for very, very long, you know, particularly on something like a CPI or a non-farm payrolls. A few minutes and it can pretty much be over. And then eventually what you'll start to see is that the profitable trades, they will offset a lot of the small losses. That's the gateway into doing it. So as you can see, what that does is it allows you to be okay with this. And if you can be okay with that, then you'll start to find that taking your loss is something that you can do. Now, how many of these do you need? To reprogram your mind in that sense, what you really need is around about 66 instances. 66, I think the science behind it says that any reprogramming of any behavioral patterns in your subconscious takes around 66 instances. That's not easy to do, so it's going to take you a bit of time to do it, but you can do it if you're disciplined in your approach to how you are executing your trades. So give it a try, see how you get on, and I assure you that is the fastest way to sort of move yourself into a position where it's okay, and you will never ever have the problem of then moving your stop loss ever again. Okay, let's move on. Let's talk about futures markets. Super excited about futures. This is coming very, very soon at FTUK. We're very excited to do futures trading. It is a very professional end of the market. There's no question about that. It can be confusing if you've never seen it before. It feels different. It just operates different. And the reasons why can be slightly confusing until you either figure it out for yourself, you do your own research, or someone explains it to you. So I want to go through some of the very, very basics. We're not going to do all of it because there is a lot, but we're just going to do some of the simple basics. And also I can talk about this till the cows come home. So we're just going to keep things as brief as possible. So a futures market, what is that? Why the future? Why not the past? What is the futures? Okay, well, a futures contract, this is what we're doing. We're dealing in contracts all the time. We are trading contracts between each other. A futures contract is essentially a promise to purchase something and then you will deliver it to me, or the opposite way around. That's essentially what that is. There's an underlying commodity at the heart of every single futures contract. Doesn't matter whether it's a sack of wheat or a bar of gold. It's a real market. So why would you want to do this? Why do this in the future? Why not just do it now? Because obviously in CFDs we do spot market trading, which is on the spot, yeah. But in futures markets, it's a little bit different. And the reason why this gets complicated is because of the speculative element baked into the mind of many retail traders. So imagine that you are McDonald's. McDonald's are a huge purchaser and distributor and user of agricultural products. Yeah, I mean, that's what they do. It's food, yeah? So beef, potatoes, sugar, I don't know, wheat, yeah, all the major commodities. That's McDonald's business, because they sell food. If you're a McDonald's customer and you go into a store, how much is your Big Mac? I don't know, $5, $10, £5. I don't know how much a Big Mac is, but it's a consistent price, and you can go into any McDonald's anywhere and expect to pay pretty much the same kind of price for that particular burger. Now, what happens if there's a drought in during the summer months and there's no wheat, or there's a flood and there's no wheat, something like that, and all the wheat fields get decimated, and all of a sudden the price of wheat goes up. All of a sudden McDonald's, they still need wheat, because you need wheat for the buns. So who's gonna buy it? Well, McDonald's will buy it, but what about, it's more expensive because there isn't much of it around. So what are they going to do? Pass that on to the consumer? Well, what that means for you as a customer is every time you go into McDonald's, one day you'll go in and your Big Mac will be $5. The next day or the next week you'll go in and the price is $30, and you'll be like, hang on, what's this? I'm not paying that. The price is all over the place. So there's no uniformity and consistency in pricing. So for McDonald's as a business, one thing that is immensely important is having their ability to be able to forecast into the future how much the operating costs of their business are going to be on the bottom line, because that's going to help them forecast how to set their prices out. Yeah. And this is why futures markets are so important, because what they want to do is they want to say, I don't know what's going to happen next year, but if I can buy my beef for next year today at this price, I know that my Big Macs for my customers will be set at this price. So I've got consistency and uniformity in my pricing as a business. You get what makes total sense when you would do that. So the futures market allows a business to be able to do that, because they can buy their commodities for next year today and lock in those prices. And then they'll take delivery of the beef, and then that's it, and everyone is happy. The reason why people get so confused with this is because of the speculative element that most traders will look at futures markets for, because what they forget is that McDonald's is not speculating. They are running a business, and they are looking to do two things. They're looking to hedge their business risk, and they're also looking to forecast their pricing into the future. And what they're doing is they're using the futures market to do something like that. Now, I'm sure there's more complicated ways that McDonald's as a company do that. I'm just using that as an analogy to hopefully make sense. But what they're doing is they're not speculating. They're using the markets to manage their risk, to offset their risk, to give the risk of the wheat field floods. That's somebody else's problem, because I've locked my prices in. They're using the futures market to do that, and they're also hedging out their business risk as well by being able to create a very smooth journey for the customer and the pricing, and forecasting their margins and their profits moving forward. Massively, massively important. That is essentially what the futures market is doing, and that's got nothing to do with speculation. And that's the bit that is confusing for most people, because as traders, as speculative traders, we see the markets as a vehicle for making money. McDonald's don't see that. McDonald's sees the market as something to hedge, something to protect the business, because their business is making money from selling burgers and fries and stuff. Yeah. Very, very different. If you understand that, then a lot of it will make sense. So we're going to cover some of the basics of futures markets. And obviously, Futures markets are all done through exchanges and centralized locations and stuff, and there's a lot of integrity in the way that is all built. But essentially, there are two types of contracts that we are going to be concerned with. There's actually three types, but we're only going to be concerned with two, and that is the E-mini and the E-micro. That essentially stands for electronic, because everything happens electronic these days. We don't do the futures trading in pits anymore. It's all done electronically. So the E-mini stands for is a fractional portion of a standard size contract. We don't trade the standard size contracts because they're just absolutely ginormous, because this is a big corporate professional industry market, which, like I said, is all built around hedging and risk offsetting and stuff by big corporations. So we trade the derivatives, the smaller size contracts within those standard size contracts. So they are primarily the E-mini and then also the E-micro. Everything goes through an exchange. This is different from working with over-the-counter markets, which is pretty much what most CFD retail brokerage tend to offer as products. So that is essentially your counterparty is a liquidity provider, or your counterparty is the brokerage, or however that has been decided, but it's over-the-counter. With futures markets, that all goes through an exchange, one central location, which stands independent to the traders themselves. And what that does is it means that you get a lot of trust within the integrity of the exchange, which is why the rules and the regulations around exchanges are just so strict. And it's because you need that trust. And it means that you don't need to know your counterparty. So I turn up at the exchange, I'm vetted, I'm cleared, I'm good for the money, I'm good for my commitment. So when I hit buy and sell, I would be okay to transact. And that means that the other guy, whoever that guy is, can have integrity that I will be good for the money. Why? Because remember, we're dealing in futures markets where there's an underlying product, there's an underlying commodity. So I've got to then either purchase the beef from McDonald's from you, or I've got to deliver the beef if I hold the contract until it expires. Yeah. So you don't need to know who your counterparty is on exchange. You just need to have been vetted by the exchange. That's why it's a very different experience. There's a lot more integrity in the price in that sense, and there's no arguments, because in futures markets, because we're an exchange, that is publicly visible to everybody, that pricing. So the opens, the highs, the lows, the close, there is no argument in it. You'll see as you go from one retail brokerage to another, you look at different price charts, and TradingView is a good place to do this. Look at the high and the low for the day's range on the euro against the dollar across a number of different brokerages. Those prices will not agree. They won't be far out, but they won't be all exactly the same. On futures markets, everything is the same. So there's no arguing on what the high print in the S&P will be today. There's no arguing over what the low print. And that in itself is something that a lot of traders find immensely useful, because it means your technical analysis is pure. It's really, really, really sharp, because it's very exact, because it's the same for me as it is the same for anybody else that's trading in those products on the exchange. So it is super important. Next, let's talk about this. And we can go into this in a lot of detail, but I'm going to do that today. You'll see that the way that things are named, it's a little bit strange. It's all over the place, or it can feel like it's all over the place. And that is because we are trading in futures contracts. If you're McDonald's, you're going to say, I want my beef in January. So I'll get the January beef today. So what you'll see is all futures contracts, they all trade in monthly codes. Yeah. Now, traders gather around certain months more than they do others. That's another conversation. But essentially, each futures contract will have a monthly expiration. Yeah. So you'll see the codes, the lettering, it looks really different on the products, and it's about understanding what each of these means. So now the reasons why this is like this, I'm not exactly sure, but F stands for January, G stands for February, H stands for March, J stands for April, and so on and so on and so on and so on. So just pay attention to this one here. U stands for September. That will become clear in a minute. Now, so if you're looking for specific products to trade, you'll see that when you then purchase a futures account with FTUK, that you can't find US 500. It's not there. Where is it? Well, it is there. It's called different because we are operating on an exchange. Yeah. So all of these products that you're used to trading are tradable. They're just called different things, essentially. So for the US 500, the S&P 500, you'll find that the code for that on the futures trading platform is ES, which I'm guessing is electronic S&P 500. If you're a gold trader, you'll be used to seeing XAU USD on your trading platform. In the futures world, on the exchange, on the trading platforms for the futures, you will identify that as being GC. If you are trading currencies, euro against the dollar, they are slightly confusing, or they're obscure, and that is they always lead with the number 6. So 6E would be euro against the dollar, 6B would be the pound against the US dollar, the Australian dollar against the US dollar would be 6A. You get the idea, but currencies, that's the codes that is used for currencies. Something like the NASDAQ, you'd be used to trading the US 100, that will be labeled as NQ. It's a little bit more obvious, that one. And something like a commodity like oil, different CFD providers can label that differently. Some will say WTI, some will say US oil, but on futures, that is the CL, that is the crude oil contract, is the CL contract on futures trading platforms. So they're all labeled slightly differently. Now, when you bring all of that together with the year that we are trading in, you'll see that the products are labeled very, very specifically. So that there that you can see in front of you on your screen is the S&P 500 E-mini contract for the month of September in 2025. So once that is, you really only need this to be explained to you once and you totally get it. But if it's not explained to you, it makes no sense whatsoever. If you're ever unsure, the best thing to do is look at the price chart. Look at the price chart, look at the pricing of the actual product, and you'll be able to get a rough idea. Okay, well, that doesn't look like the NASDAQ because the CFD NASDAQ looks completely different, yeah? That's usually the fastest way of figuring out if you've got the right one. But you'll get used to it with time. It's just a question of practice. So ESU5 that you'll see on the platform will be the September expiration. So for 2025, the last digit accounts for the year. That's how that works. The other contract that we'll be trading, which will be a 10th of that size, those E-mini sizes, will be the micro. And the way that the exchange makes those clear on the trading platform is by adding an M at the front for micro. So you get the naming convention. It does start to make sense once it's explained to you. So for a micro E-mini S&P 500 futures contract that expires in September this year, it will be MESU5. Hope that makes sense. We can talk about this a lot. I think what we'll do is we'll break this down week by week until we launch the futures, and we'll go through these things in stages bit by bit because there is a lot to it, and I get that it can feel like a bit of an information overload, but it does make sense, and we are super, super excited to bring the futures to FTUK clients very soon. Okay, that's pretty much everything we've got for today. Just to let you know that we've got a fantastic, cool offer on the website at the moment. The summer theme, Heat 25, it is still quite warm here in the UK. So Heat 25 is the code that you need on the checkout. And for that, you're going to get a 25% discount. And that's across all of the products, all of the accounts that you can get with FTUK. Instant funding. You also get some add-ons thrown in there as well. You get the level 7 added in there as well. That's the extra bit of capital at the end of your scaling program. You don't get level 7 right from day one. It's added in there right at the end for you. And then also you get a 20% payout booster as well. So whatever your withdrawal amount is, when you make your withdrawal on the instant funding, we will add another 20% onto that as well. It's not increased profit split, but it's still a very, very cool deal. 25% off your instant funding, and then also as well on the challenge accounts as well, 25% off, and you get the level 7, but you also get news trading as well added in there as well. So please do take advantage of that. That'll be available all over the weekend. Heat 25 is the code that you need on the checkout. Goodness me. We are done for another day. That is everything we've got for today. Yeah, thank you very much for joining us. Non-farm payrolls will be next Friday. We will be covering that live. Have a fantastic week in the markets, and we'll see you all